Private equity firms can make a big return when their portfolio companies go public. But typically that payday doesn't materialize right away. In fact, only 3% of private equity firms fully exit at the IPO. Instead, they sell their stakes slowly, in incremental sales known as follow-ons. The average PE firm finishes selling its stake 3 years after the IPO. That includes the initial 6-month lockup period, which is standard in IPOs. And many private equity firms hold for even longer, some for more than a decade, as they hope to sell above the IPO price. But this year has proven to be an unusual one for follow-ons. New data shows that private equity-backed follow-on sales are up 180% year over year, but almost 2/3 of those deals were priced below the company's IPO price. One example is Blackstone. 2 months ago, the private equity giant sold its remaining stake in dating app Bumble for half of what it was worth when Bumble went public in 2021. In other words, private equity firms are scrambling to sell their stakes, but they're doing so at massive discounts. So my question to you, Scott, why are they doing this?
Because they can do math. And that is, if you look at, I remember meeting a guy named Don Valentine, who was, I think, the founder of Sequoia Capital.
Mm-hmm.
And I met him at a talk that he gave at Haas. And this must have been 20, 25 years ago. And he said the biggest mistake they made was not holding on to the equity of their companies that went public. And they invested in companies like Amazon and Google. And a lot of private equity players and VCs said, looked at these unbelievable growth companies that turned into just giants.
Yep.
If we'd held on to this company 2, 3, 10 years post-IPO, we would have made a zillion percent. But then the entire retail market got horny for those types of returns and started piling into total shit, like Virgin Galactic and, just stupid shit, right? Things that made absolutely no sense. And these guys, and the whole market got taken up. And these guys look at basic things like price earnings, and they realize that regardless of the heat, regardless of what's in trend or off trend, ultimately fundamentals raise their head. And when you look at a company like Bumble, I'm sure they did the math and said, okay, let's value it against Match. Let's value it against other companies growing at the same amount. And even at half of where it was trading at its IPO price, ignore the IPO price. And this is what you're supposed to do as an investor. You're supposed to ignore history. You're not supposed to anchor off of past prices. I have trouble buying any stock. I look at NVIDIA, I think great stock, but it's up 140% this year. I shouldn't buy because I hate to buy things. I hate to miss out. But the reality is you should just look at it here today. And what's happened to it makes no sense. And so the PE guys look at a stock like Bumble and they go, okay, even though it's been cut in half, it's still overvalued. Mm-hmm. And so we should get the hell out of Dodge. Typically what they did is, to be good actors, is they sold slowly. They didn't want to impact the market. They didn't want to take the stock down. Mm-hmm. They wanted to be good investors. Maybe there's some upside here that we can participate in. If we sell a little along the way, we get some of the updraft, but we start taking some money off the table. And also, PE firms aren't supposed to be public markets investors. That's not why, that's not why CalPERS invest in them. If CalPERS wants public market investors, they'll invest in a hedge fund that invests in, stocks.
Could you explain to us what CalPERS is?
Well, it's the pension fund for, I think, California teachers. Is that right? California, or it's the pension fund for California employees. I forget which one it is.
Teachers. Sorry.
Oh, is it teachers? Excuse me. But it's enormous. And it's also considered great capital because it's very sticky capital. Once they invest in you, they usually, keep their capital there. They don't redeem. And that's what you want as an investor. You don't want hot money. You want money that sticks with you. Anyways, they're a great investor. They don't need to invest in a private equity or a VC firm that all of a sudden thinks that they're in the business of managing a stock portfolio. That's not why they invest in them. So they have an onus, and it's in their kind of mission, if you will, to sell out. But they do it usually slowly. But in this instance, when they look at a market where retail investors have pushed, kind of mediocre companies into stratospheric valuations, they do a partners meeting and they go, okay, this is a great company. We've done really well here. And traditionally, companies like this trade at a PE of 20, and this one's trading at 80. It used to be trading at 160, but it's still trading at 4 times where it should be. Let's get the hell out of Dodge. And they also probably are in the midst of raising another fund. A lot of it comes down to something called a mark. And that is, whenever you see bad behavior on the part of an investor in a board meeting, it's usually got something to do with their mark. And that is, say their fund isn't going very well, but this is the one stock that is going well. And rather than raise 200 million at a lower valuation for a private company, which would make more sense, they'd rather raise 50 million at a flat valuation, even if it's just related parties around the table, because they don't want to mark the value of their stake in that company down, because then they would have to report that to their limiteds, which takes their returns down, which makes it a little harder to raise money for their next fund. So there's a lot of jazz hands and a lot of things that go into timing around sales of private investors.
So one thing I didn't realize is, but it's totally obvious now that I know, when you hold on to those public holdings, you still get to charge a management fee. So the management fee is around 1% to 2% for private equity and VC firms, which basically creates an incentive to continue to hold on to your public holdings. And just some data, I didn't really realize this. As you said, private equity firms are not supposed to be investing in the public markets, but the average period at which a private equity firm sells its stake is 3 years after the IPO. In roughly a quarter of deals, private equity firms retain around half of their holdings after 5 years. It feels like there's this strange incentive for the general partners to keep charging fees by holding on to their stake for as long as possible. Do you think that that's accurate? Am I being too cynical there?
I just love it when the student becomes the master. You're figuring out this is a racket. And this is typically, roughly speaking, the life of an asset manager.
Right.
He or she outperforms the market. They raise a few $100 million. And with that money, they're all over everything, and they can be really nimble. They can go into smaller companies. You know, the whole world is their universe.
Yeah.
And they can be all over stuff and apply a small group of really talented people to finding great opportunities, and they only need a few. And then because they post great returns, they go out and they're able to raise a lot more capital, which means they have to put more capital to work, which limits the investments they can make. It means that they have to hire more people that maybe aren't as talented as the original investors. But all of a sudden, their returns become secondary to that 2% management fee.
Yeah.
If you're a $1 billion credit fund and you post great returns and you're able to go out and raise 5, 10, then 20, on January 1, you make $400 million. And so your incentive becomes just to not do worse than the market.
Yep.
And you become a company that's not too big to fail, but has the credibility such that the investor won't get fired. Yep. And that is, asset allocators or people who work for these pension funds are not only in the business of making money, they're in the business of not getting fired. And when you invest in a Bridgewater or whatever it is, a big, an Andreessen Horowitz or Sequoia, you have defense. Even if the returns are awful, it's like, well, wait, it's Andreessen Horowitz. Wait, it's Kleiner Perkins. Wait, it's Sequoia Capital. And over time, oftentimes these funds, their returns diminish. And so they become asset collectors more than investors. Yeah. And that's why a lot of funds used to have a certain amount of capital allocated to new managers. And then in general, private equity has been mostly about let's raise money and let's invest long and let's put up gates. We get captive capital for 5, 7, 10 years. Yep. And in a bull market where everything is kind of going up and you can borrow money at insanely low interest rates, private equity is just about not being stupid, making a series of investments, and then the structure is you're just going to make a shit ton of money because we have a bull market going up 8% a year, and we can borrow money at 2.5% to get leverage. What do you know? We look like geniuses. So private equity has been an unbelievable business, but distinct to private equity, if you were to just aggregate all returns for alternative investments, they have pretty much exactly underperformed the S&P by the amount of their fees. And that is, in a weird way, I've been thinking a lot about unions. I would bet if you looked at what union membership has done, and I imagine there's an academic somewhere, has done for wages, that you would find the wages are about similar to non-union workers, except minus the cost of the actual union. And that is, I think the market, there's valleys and there's peaks, but the market wins and pierces the union. Yeah. And they're subject to the same supply and demand as everybody else. What has happened in alternative investments is it's a luxury item. And wealthy people and institutions like to think that they're smarter and they should get better returns by hiring smart people and paying for it. And what you find, especially over the last 10 years, the way you would categorize or largely brand the hedge fund industry is expensive but bad. And that is the returns have not only been the same as the S&P, they've been worse because no one will pay a hedge fund 2 and 20 to buy Apple or Nvidia. It's like, boss, I can do that on my own. And those stocks, those large cap, big name stocks have underperformed the stranger Byzantine stuff that these folks are supposed to find. So in sum, if you were to say, the whole market is a giant head fake, the whole market is just basically a bunch of jazz hands and a bunch of people waving their arms, trust your instincts. This is an industry that is largely built on marketing, fear of missing out, and wanting to feel like you're smarter than the other institution or the other investors, so I invest with the hot manager. But it's mostly, what's the term? It's mostly bullshit.
So a couple of things. It just reminds me of this bet that Warren Buffett made back in 2008, where he made this bet with his hedge fund protege partners and said, I bet you that if I invest in the S&P 500, you can invest in whatever assets you want. I bet you that my returns over 10 years will beat yours. He was losing in the first 2 or 3 years. And then eventually in year 8, protege just gave up because the S&P was outperforming, which gets me to the point that you made, which is PE firms are long-term probably going to give you roughly the same returns as the S&P, except you also have to pay a management fee. So 2 questions. One, why do people invest in private equity? Is there something we're missing here? Maybe there's some massive upside in certain scenarios. And 2, do you think that we should just be getting rid of those management fees? Do you think it's maybe fair that VC and PE shouldn't be charging that?
Well, it has nothing to do with fair. It's what people, there's 2 sides of the transaction and people can decide what they want to do. But I'll ground this in my personal story, which I'm very good at. And that is when I was much younger, I had the opportunity to invest along Kleiner Perkins in a wedding registry, a web-based wedding registry called Della and James, I think it was called. And I called my partner and I said, oh my God, I think I was 29 at the time. I'd made a little bit of money in a company I started called Profit, maybe 30. I'm like, good news of good news. Kleiner Perkins, the premier VC fund, will let us co-invest with them in this wedding registry called Dell and James. So we scraped together everything we had, $250,000. 18 months later, it was a zero.
What?
And well, this is the internet. The thing made no sense. The technology never worked. It just went straight to zero. And at the same time, and let's fast forward, I've learned my lesson. I will not pay fees. And this is a story of privilege because I get to co-invest with really smart private equity and VCs, and they are smart. But unless I can co-invest without fees, I don't do it. I just say right off the bat. And most people don't have access. I'm considered, quote unquote, a value add partner in some of this shit, which, again, talk about jazz hands and a head fake. But occasionally, a VC or a private equity fund will call and say, we're making a media or a tech investment. We'd like you involved. And I usually not only say I'm not going to pay fees, but sometimes I ask for additional options. So I pay negative fees, if you will.
Yeah.
You should never pay fees, Ed. You should never pay fees. This is what you should do. You should invest your money in a series of diversified ETFs and index funds from Vanguard, and you should as low a fee as possible because as exciting and as much as you want to believe that you're smart and can identify better managers who've gotten a lot of press and are on CNBC a lot, and they'll make you feel like you're getting to invest in something differentiated with people who are smarter than you, no one has any fucking idea what's going to happen in the markets. If you buy one stock, there's a 49% chance it'll go up the next day. And there's, in 5 years, 10 years, there's about a 40% chance it'll be down, 60% chance it'll be up. You pick any 5 stocks in the S&P, and if you hold on to them for 10 years, nobody in the history of the markets has ever lost money. Ever. So what's the key? Low fees, diversification, and then recognizing all of this is a lot of marketing and a lot of jazz hands. So here's the bad news, or here's the good news. I know how to get you rich, The bad news is the answer is slowly. And there will be a series of well-publicized hedge fund managers that outperform the market, and some of them are exceptional, but eventually the inflows of capital will starch out those returns, or luck, which tends to be symmetrical, they'll get their dose of bad luck. But the entire industry is a giant exercise in marketing. Be very careful going into funds where you feel like you're getting some sort of special access and pour all over the fees. 2 and 20, I think Vanguard charges like 10 bips.
Yeah.
So that means the other guys, the ones charging you 2 and 20, have to outperform by what is that, 2.5 or 3% a year?
Yeah.
I mean, that's just really difficult. You're betting on a horse that has a jockey that went to Prince. I'll give him that. But who's 30 pounds heavier than the low-fee jockey on the other horse. I like that metaphor. I'm going to stick with that. So my message to young people is try and resist the temptation to think you're smart or that you have access to some sort of special investor. They may not know less than you, but they don't know a lot more. The key is diversification and low fees.